with the current market state, there are a few things that we need to understand. Number one is we're not in a rate term market. That was the pandemic. The pandemic was the rate and term market. Rate and term basically means that you're just lowering your rate and interest rate. You're not getting cash out, right? So you're just lowering your interest rate and payment. That's a rate and term refinance or transaction. This market that we're in is a cash out market because the rates are up, but so is consumer spending, so is consumer debt. And so a lot of people are leveraging credit or debt in order to sustain their living, in order to make ends meet. And so we are in a position where this is now a cash out market because many homeowners have a ton of equity, and we can technically use that advantage to deliver some sort of benefit, regardless of the rate increase or the amount of fees. It's just a matter of understanding that we are no longer in a rate and term market. So what that means is, of the two types of leads, or two loan types, I should say. So you have government, which is one loan type, and government is your FHA, your VA loans. And then you have the second, which is conventional, Fannie Mae, Freddie Mac. So Fannie Mae, Freddie Mac, I would say, in my opinion, is probably representing less than 10% of my current monthly business. And the reason for that is because, even though you may pay off debt, even though you may be able to provide some sort of savings, you have more resistance on that versus a government loan type. And here's the reason why, is because whether you have a VA loan or an FHA loan, you have a unique ability to do what's called a streamline. So VA, the streamline benefit is called EARL, which is acronym, stands for interest rate reduction loan. FHA, same thing. It's called streamline. It's a streamline refinance. And so that is in your back pocket, and that serves value because those particular transactions, they're not cash out. They're simply designed to lower the rate and payment. That's all it can do. As a matter of fact, you have to lower it by at least half a point. On your VAs, you not only have to do that, but you have to also recoup the cost of the transaction within a specific amount of time. And so anyone who has a VA or FHA loan always will have access to that. And the reason why it's important for you to know that is because when we sell them on a cash out government transaction, we need to plant seeds about that streamline in order for them to help understand and accept the interest rate. Because most homeowners, they believe that when they go into a new refinance, that the term that they're gonna get, they're just gonna have it forever. And it's weird because the average, turn time of people refinancing is usually about 18 months to 2 years. Very rarely come across someone who's had the same loan for like 2 or 3 years or more, especially because of the pandemic. So a lot of the traffic that we're running into, they already refinanced within the last 2 years because of the pandemic. So with that in mind, what we need to know is that government loans is really gonna be something that you want to heavily focus on. If you're hunting through like title data, or as a broker, you're buying leads, I would probably not necessarily reference conventional loans. I would look at like VA, which is pretty cool. It's unique. You can go up to 100% of the property value. There's no loan limit. So you could literally do a VA loan for like 1.6 million. Whereas like FHA, they have loan limits, right? And the loan to value on a cash out with FHA is usually about 80, it's 80%. VA can go up to 100% so long as you meet a specific criteria. So I want you to keep that in mind.